Hi, I'm Wee Kuang, Research Analyst from Phillip Securities Research. Today, we will be covering our Singapore Banking Monthly Report, which covers some key happenings within the banking industry over the past month. The banks reported their third quarter results for 2020 at the beginning of November, and the key highlights are summarized in the table on the screen. Firstly, when we look at net interest income, it generally fell by 11 to 13% across the three banks, as net interest margins were compressed amidst the low interest rate environment, while loans growth remained weak in the current business environment. Next, we see that for non-interest income, all three banks also recorded a year-on-year decline, but observed that there was an improvement of between 14 to 17% quarter-on-quarter as banks resumed their businesses after Singapore exited the circuit breaker period. Other non-interest income was uneven across the three banks, but this was largely attributed to the different levels of trading income. The banks continued book building in the third quarter, as allowances remained at a heightened level. However, we saw a tapering of allowances quarter-on-quarter for DBS and OCBC after they had front-loaded allowances previously in the first two quarters of the year. However, for UOB, we do note that they have been recording lower specific provisions compared to its peers over the past few quarters. Moving ahead, we see that interest rates have remained relatively stable quarter to date. With interest rate at its lowest since 2013, we believe that the rates will continue to remain low going into 2021. As such, if we were to take the third quarter net interest margin as a guidance, we should see similar run rates for net interest income going into 2021, and full-year net interest margin for 2020 is expected to drop from 1.63% as of third quarter to 1.60% for the entire year. In terms of loans outlook, latest data from MAS showed that lending continued to worsen in October, with loans falling 2% year-on-year, marking the sharpest decline since August 2016. Business loans fell by a larger margin of 1.96% in October year-on-year, while consumer loans also fell by a similar margin of 2.06% year-on-year. Consumer loans have grown for the fourth consecutive month. Nevertheless, the weak loans data will pile pressure on net interest income alongside the low interest rates moving forward. In November, we saw capital market exhibit a strong performance, with securities daily average volumes up 35% year-on-year to heightened levels last seen in June. Turnover volume for the top 5 equity index futures also grew 11.6% year-on-year. More importantly, we have seen the FTSE Taiwan Index futures turnover reach levels similar to its MSCI substitute from a year ago. This comes ahead of the cessation of the MSCI license in February 2021. As such, we believe the impact of the MSCI license agreement cessation to not have any material impact on SGX's earnings in FY21, as compared to the 10 to 15% earnings impact provided by the exchange previously. Generally, the better performance of the market is likely attributed to the conclusion of the US elections and the positive COVID-19 vaccine news during the month, but we do expect trading volumes to do well on the back of greater market participation moving forward. Next up, we move on to some of the news flow within the banking sector in November. Firstly, the Reserve Bank of India formally approved of the merger between DBS and Lakshmi Vilas Bank, with the merger in force with effect from the 27th of November. According to various sources, DBS is expected to inject Singapore dollars $467 million into the merged entity, which will contribute to some short-term cost headwinds for the bank, alongside ongoing losses incurred by Lakshmi Vilas Bank. Then, on the 4th of December, 4 digital banking licenses were awarded by MAS, including 2 digital full bank licenses and 2 digital wholesale bank licenses. The successful applicants for the 2 digital full bank licenses are the Grab and Singtel Consortium, as well as C Limited, who is the parent company of Garena. As for the digital wholesale bank licenses winners, they are Ant Group, as well as a consortium led by Greenland Financial Holdings. All 4 digital banks are expected to begin operations in 2022, and we do not foresee any impact on the incumbent banks in Singapore, as the licenses held by the local banks allow them for to undertake the same activities as the new entrants, and they do have a head start in the race to digitalization with their operational know-how. And that's all we have for our banking monthly report for December. We continue to maintain the Singapore banking sector at neutral. This is because even as the credit outlook within the industry brightens with more clarity on asset quality, we expect earnings only to recover to pre-COVID-19 levels in 2022. We also downgrade OCBC and UOB to neutral and maintain DBS at neutral on the recent share price rally, even though there was an upward revision in our target prices. You may find our old and new target prices in the table on the bottom right-hand corner. Within the sector, we prefer UOB due to the lower specific provisions that the bank recorded over the past 3 quarters, as well as the lower credit cost guidance going into 2021. This means that UOB is likely to see a swifter recovery in earnings when compared to its peers. Thank you.